What's up, guys? Ben Samlack TV here. Thanks for tuning in. Thanks for taking time to check out this video. What Napoleon Hill said really stuck out to me, and I thought I'd share that with you. We're not talking about Napoleon Dynamite. We're talking about Napoleon Hill. Think and grow rich. He's helped millions of people. He's helped myself included. So when I was at the gym the other day listening to Napoleon Hill on one of the videos that he had, he said something that stuck out. So I wanted to share that with you guys first off. So let me share my screen here real quick. And I'm going to share with you this video. I thought it would be very helpful. So here we go.
Work out a plan of your own. And if it's your plan, it'll be better than if I give it to you verbatim and you just follow it. Now, the suggestions for budgeting of time, budgeting of income and expenses. First thing on your list, your monthly or weekly amount of income should be put down. Should have a regular book worked out, a budgeting book. Now, if you have a family or if you don't have a family, life insurance is a must. It's absolutely a must. You just cannot afford to be without it. If you brought children into this world to whom you're responsible for an education, it's up to you to insure yourself so that if you pass out of the picture and you don't earn any longer, they have got enough money to educate themselves with. That's just a must. And if you've married a wife that's dependent entirely upon you, it's up to you to carry enough insurance to give her a down payment on a second husband if you should pass out of the picture.
So there you guys go. Very, very, very true, right? So he's saying out of all the different things you can do to start off, the first thing, if you want to start to grow in wealth and to have success in life, is to get a life insurance policy. And this is so true. Now, I have multiple streams of income. I do many things, one of them of which is sell life insurance, because I feel like it's so helpful. And it's more than just to protect yourself if you die so your family gets money. It really is a great way to start off preparing for retirement. So especially if you're young, you have kids, you don't have kids, you're married, you're not married, this is a great place to start. There's a lot of different ways to start to plan for retirement. Now, two things people usually are afraid of. Number one is they're going to run out of money in retirement. Number two is they may get sidetracked with retirement by getting sick, cancer, heart attack, stroke, which can happen to any of us at any time. So that could happen, that happens to people many times, and they have to use their retirement money to pay the bills because, you lose your job. Thank God for all the technology these days and medical breakthroughs that, my mom had cancer. She's still cancer free, thank God, but, you could lose your job with that, and your medical insurance will cover your medical bills, but it will not cover your mortgage payment or your car payment or your cell phone bill or your food. So in that sense, you start to deplete your retirement and you got to start all over again. So if you want to start to prepare for retirement, there's a lot of vehicles, if you're young especially, that you can start to contribute to. A Roth 401k. That's something that you put in taxed money. It grows tax-free. You can put up to $6,000 at this time. You can put up to $7,000 if you're older, and let that money grow tax-free. So when you retire, you can actually pull it out tax-free. That's one of the only vehicles that does that. 401ks, we all know that most people know what that is, especially if your company matches. You can put in some money and let them put in some money, and then pull that out, but it's taxed when you pull that out. Same with the 403b, annuities, same thing. Annuities, all these different vehicles you can start to contribute to or roll funds into, whatever. But the number one thing, when people come to me, what do I recommend is, if you're just starting off, especially you want to start off with a life insurance policy. And that's for sure, if you, like Napoleon Hill was saying, if you have kids or if you have a husband or a wife who's dependent on you, you need to get life insurance starting off. That's the number one place to start. And there's 3 different policies you can do. You can just say, Ben, I only want to put in $20, $30 a month. I just want to cover my family. And depending on how much coverage you want, that'll determine that. If you're healthier, same thing. It never gets cheaper. It always gets more expensive as you go on. And everybody thinks nothing's going to happen to me. That's when I talk to these people. I'm just going to wait. But like I said, number one, if you pass away young, now you're leaving behind your kids. Why are you dependent on, you're going to hope that GoFundMe is going to take care of your kids or your wife or your husband, when you could have just put in $20, $30, $40 and your spouse would be taken care of and your kids would have education money, and it's all done. You don't have to worry or hope that someone else is going to take care of your family if something happens to you, when you could have just did it. Number one. Number two, there's if you get sick, a lot of these policies, cancer, heart attack, stroke, these major illnesses that really can take people out and deplete their, like I said, deplete your retirement and really off track what your progress you've made. These cover those things. So if you get cancer, heart attack, stroke, and you lose your job, you can start pulling from the benefits to take care of all these different things so that you don't have to deplete your retirement. And like I said, my mom's cancer free now. So, even if it takes you a year or two to get, healed, you still will not have to waste all that time in retirement money, start over and be kind of set back. So that's number one, a term policy. That's the cheapest. You can do 15, 20, 30 years, and that will just cover your family and cover yourself if something were to happen. Number two, there's whole life policies. That's for usually if you're a little older, if you're a little sicker, there's insurance that will cover you. And I'm contracted by a number of carriers. I'm an independent broker, so I'm not trying to push someone into some company's policy or some bank policy. I'm really trying to find the best thing for most people, for whatever person, is best for whatever that person is, whether it's price, whether it's getting approved. So that whole life policy, you may get less coverage, but you're not going to be dependent on your kids if something happened to you to pay for your funeral, to pay for your mortgage payments so they could try to sell the house, or they can lose the equity in your home because they can't cover your mortgage payments when you passed away. Or if they do have money, that's fine, but that's taking away from your kids' money. So I always tell people who are a little older, that's something that's very helpful. Like if my mom and dad passed, that's fine. I got money I could take care, I can help one of the other one. But if I don't have to come out of my pocket, that's money that could be for my kids, Disney, or that could be for my kids, something I could have been giving something for my wife or kids, but which is totally fine. But how much more helpful that would be, how helpful that would be is if your kids didn't have to do that. So that's a whole life policy. Those whole life policies have a cash value in them. It's like a savings account. So part of the money goes in. So if you ever need money, you can pull it out. You can surrender the policy and use the cash for your needs. So it's kind of nice. But in the short run, if you pass, your kids get that money, or your beneficiary, your wife or your husband. Thirdly, there's something called an IUL. This is the one I would recommend. If someone were asking me, a friend or family, I'd say this is all for educational purposes. Of course, just throwing that out there. I'm not a financial advisor. I am licensed by multiple states. So in that sense, I am able to put applications in for these things, but I'm just giving this as more educational purposes. So an IUL is something I would tell people about if they're just starting off young, healthy, and they're, whether you have a wife or kids or not. This is something that's very helpful to not only help you in case something happens to you in the short run, protect your family and loved ones, protect you from cancer, heart attack, stroke, or any critical illness, but it also is helping you prepare for your retirement. It's another vehicle, an IUL, that you can prepare for your retirement. And it's a great vehicle. So this to me would be if it was my brother or sister and like, hey, Ben, where should I start? Should I start with a Roth, a 401k? Yes, those things, if you can start to contribute to those, that's a good place to start. But I would also say the number one thing I would say, get yourself an IUL, a life insurance policy in some way. But an IUL, if you're young, is a great way to start, because not only are you protecting yourself from getting sick and getting sidetracked from retirement, there's a cash value that grows at an interest rate in that one because you're younger, and it grows in time, tax deferred. So that money's growing tax free. And a lot of rich people actually use these policies. I didn't even know about this until I started selling life insurance. So when I found out about this, I got this for me and my wife. I wish I would have got it a lot sooner, because that money's growing and it's indexed. So, and it's safe. So your Roth, your 401k, your 401(k), your 403(b), these are all susceptible to market volatility. So you could retire and think you could have 500,000 in those accounts, and then you're retiring during this year when the market went down 30%. So now your funds are 30% lower. You had it all calculated out. You thought this money was going to last you till you died, and now you come to find out, man, I'm 30% depleted, and I got to start pulling from these accounts now because I'm retired. So you don't want that. You want to be diversified. You don't want to have everything in accounts that are susceptible to market volatility. You want to have some of those funds in things like annuities or IULs that if the market crashes, you're protected. There's a floor. You can't lose in these vehicles. You're giving up the ability to have some of the gains, but these vehicles have really good gains, 5%, 6%, 7%, 8%. There's some really good gains in these. So, if you want to get some illustrations and things, I can do that for you just to see, hey, Ben, what would this be? But just so you know, this IUL is to me is a really nice vehicle because you can put in a small monthly payment, and not only is that covering part of your insurance, part of that money goes to growth. So if you look at a 20, 30-year illustration, by the time you retire, there's a good chunk of money in there, and you were covered all along the way if you got, something happened to you. You can then either surrender the policy, pay taxes on the money that's in there, and just take the cash and run, or you can start to pull out monthly income tax free, just like a Roth IRA, never pay taxes. You're borrowing the money out. So, it's the money you're borrowing out, you have to pay interest, but you never really have to pay it back in theory if you don't want to, because you're pulling the money out to use, and there is a death benefit. So if you pass away, they just take the money that you borrowed out of the death benefit, and the rest of that money goes to a legacy or inheritance to your family. So it's one of the only other vehicles that has a death benefit to it. So your Roth, your you know your 401k, once you run out of that money, it's gone. With this, you can deplete that, and as long as you keep making that monthly payment, if you pass away, there's still going to be some death benefit money there to go to your family, which is awesome. So not only is it tax deferred, tax free to pull out, to borrow out, there's also a death benefit still as an inheritance to your family that you can give to them. And when they get that inheritance, it's tax free. Okay, because it's a death benefit. Whereas if your Roth, if you pass away and leave your Roth to them, or some of these other, your annuity, you leave the death benefit. Your 401k, that's still going to be taxed when your family gets it as an inheritance. Whereas with this, the death benefit is not taxed. So it's to me, it's a wonderful vehicle for you to protect your family, like Napoleon Hill said, your kids and your spouse. But then number two, to start to have you're diversified. You could look at illustrations of how that money is growing, and it does depend on how the market does, of how it will grow. But you can kind of get an idea of how things have performed in the last 20, 30 years and say, okay, this is what it's going to look like. And you can know for sure that even if it doesn't grow, the money you're putting in, like I said, there's a floor of zero. You will have money in there for retirement. The money you're putting in will not be lost. The part that's going to the cash value will not be lost. Okay. And then depending how the markets do, there'll be more or less in there. Whereas your IRA, your 401k, all these things are susceptible to market loss. And so you really don't know when you retire what's going to be in there. You really don't know. So those vehicles, I'm saying those are great. And to be diversified, it's nice to have some money in your Roth, your retirement vehicle, whether it's 403b, a 401k, whatever. And then, you have your pension, but then to have an IUL to me is another nice little, diversify yourself, to have something that's growing there that will be there. And if you pass away tomorrow, your family gets the full death benefit, and they're taken care of. So that's all I wanted to say. That's a little lesson I wanted to give today. If you have any questions, you can email me. My email will be in the comment box, comment down below, or the description box. Comment down below if you have any questions. And that's all. I'm going to stop there. So thanks for tuning in. Hopefully that was some helpful information to you guys. And it was, thank you for your time, for supporting the channel. Continue to support the channel. I can make more videos like this to help educate. And reach out to me if you need anything. If not, thanks for tuning in. I'm glad you still were able to watch. Hopefully you learned something. Tune in next time. Ben Samlak TV. Bye.